if you have been waiting for lower rates, you're going to want to pay attention to the March 20th Federal Reserve meeting, because they're going to be talking about not just inflation and employment, but banking liquidity and a process known as quantitative easing. Now, quantitative easing, you've heard this in the past many times, but this is the measure in which the Fed injects liquidity back into the market to stimulate spending, and oftentimes they buy assets like mortgage-backed securities, which has historically lowered rates. And so this is going to be a hot topic. We're going to break into why this is happening right now and why it matters to you and your home purchase. Now, before we get into that, I am going to ask you to like, comment, and subscribe. And if you find this video helpful, I hope you'll share it with a friend. Now, for those of you who are new to my channel, my name is Lizy Hoeffer. I'm a residential loan officer at Cross Country Mortgage, and I created this channel to teach practical money tips so that people could make smart home purchases. Now, over the last 2 years, I have now started giving people simple explanations of complex economics, because they're often spoken about in the news, but they're rarely taught to us as consumers and honestly citizens of the United States. It's really frustrating to not understand what's happening with the economy. And if you are going to be a smart home buyer, you need to know tactically when the best opportunity arises for getting into the housing market. And so today we're going to be discussing a whole bunch of economic terms and how they relate and what will happen when interest rates drop, because I believe there's going to be a big buying frenzy on the horizon when that happens. I think a good place to start the video is just to give a basic overview of what inflation is, quantitative easing, and quantitative tightening, because those are the three things that have been at play over the last 4 years since COVID. Now, most people have a general idea of the Federal Reserve's job because they're in charge of monetary policy, but essentially their two main jobs are to keep the cost of goods and services affordable in the country and to maintain relatively low unemployment. Sometime in 2022, it was determined that the US economy no longer needed stimulus. There are some experts that say that we waited too long to make a change, and there's some experts that are still arguing that inflation was never that big of a concern, that it really was transitory, and that the Fed's intervention to slow down inflation has been an overcorrection. It doesn't matter what side of the fence you are on, because quantitative tightening started in June of 2022, and this is the reverse process of quantitative easing. So this is where the government starts to sell off their assets for treasuries and mortgage-backed securities. This is why mortgage interest rates started increasing at such a rapid rate, and they start raising the Fed funds rate, which makes it less affordable for banks to borrow from each other, and in turn those higher interest rates are passed on to consumers, which hopefully should slow down their spending, which is not something that we have seen. And so because consumer spending is still kind of out of control, they have rapidly increased this Fed funds rate at a historically fast pace, which is causing some additional issues in the banking sector, which is why this March 20th meeting is so important. So in order to understand how quantitative easing and quantitative tightening impact the banking system, it's important to really understand how the banking system works. So most consumers are familiar with the fact that the banking system manages cash flow throughout the US economy in ways of like lending for things like auto loans, credit cards, HELOCs, mortgages, you name it, and they receive deposits for checking accounts, savings accounts, CDs, and investments, right? So they understand that the banking system's purpose is to manage cash flow, but they don't understand its relationship to the US economy and the Fed funds rate. And so in order to explain this, I want to give an example that I think is easy to understand for everyone, but imagine the banking system is like a bunch of money shops, and these shops have enough money to give out loans to people who want mortgages or want to start businesses, but they also have to have money enough for people who want to take out their money. And so because it's a constant process of deposits and loans and withdrawals, sometimes banks have to borrow money from other banks either overnight or for weeks or for years at a time, and they borrow at the Fed funds rate, which is set by the Federal Reserve. And so they're banks borrowing from other banks to meet their loan fundings and withdrawals. what people don't understand also is that banks typically invest all of the money that we deposit with them in investments that yield a higher percentage than this Fed funds rate. So in essence, they're borrowing money overnight, but the interest from other investments, let's say loans to other banks or investments in things like a real estate trust or a hedge fund, right, will cover this interest payment for the Fed funds rate. So they technically either break even or they make money. Now, because the Fed funds rate has been increased so rapidly, the investments that banks make with our deposits haven't been enough to cover, right, their interest payments. And so it's eating into this banking reserve, which goes towards liquidity for funding things like loans and making withdrawals. Up until recently, liquidity really hasn't been an issue because banks have had so much excess reserves due to the last 4 years. And because of that, there are two processes at which the Fed will borrow money overnight from banks. One is called the reverse repo facility. And you could think of this like a special savings account. This is when banks have extra money and they loan it overnight to the Fed and earn interest off of that. And then there's this thing called bank term funding. And so this is a longer term loan to the Fed, again, at a higher interest rate. And it keeps banks playing longer in the game of funding loans and making their withdrawals. Over time, the Fed funds rate has increased at such a rapid pace that the investments that banks make, in this short-term funding overnight or this longer-term funding to the Fed haven't kept up with the interest from the Fed funds rate. Their profits from deposits on other investments haven't kept up with the Fed funds rate. And so their reserves have been depleted. And we are now facing a liquidity issue with the banking system at large. In order to give a simpler example of this, imagine that our US economy is like a game of Monopoly. In a game of Monopoly, a stable economy have people and businesses, they earn and spend money based on their budgets and their incomes, just like we do in real life, and they use those incomes to pay their debts and all of their credit cards. Now, but let's say a storm hits or a pandemic, and all of a sudden, in order to keep the game going, the Fed, right, which is the banker in our game of Monopoly, has to inject money into the players. So they give out bonuses and they lower interest on their credit cards and their debts. And this makes it cheaper for the players to keep playing. And this process is known as quantitative easing. Now imagine players get out of control and they start spending and spending, and now the prices for things like rent and the cost of consumer goods get out of control. And the only way for the banking system to reel this in is to then increase interest rates and to start making it less affordable for their businesses to operate. Now, less affordability means that they will stop spending, eventually. But let's say that this just takes a really long time. And so then the banker, the Fed, has to get even more aggressive. In this game of Monopoly, players still have the option of creating or generating more income based on extra money that they have. And so they might loan it back to the bank, let's say overnight, which is that reverse repo facility, or they might lend it to them longer term, which is that bank term funding, but this is money that they're lending back to the bank. Now, assume that the interest that they're receiving on this doesn't meet the rate at which the Fed or the bank has increased interest for these businesses. Now they're depleting their savings to continue playing in this game. Now, eventually the money runs out, and when the money runs out, the game stops. So this is why this March 20th meeting is so important, because obviously the US economy cannot stop. The banking system needs liquidity, and the way to do this is through more quantitative easing, which means that they're going to be printing out more money to buy assets to free up cash for the banking system. Now, when they do this in mortgages, they buy mortgage-backed securities, which is those pool of mortgages, which frees up cash so that banks can loan out for things like mortgages, which has historically dropped rates. So this is really exciting, and it is stuff that you'll want to pay attention to. I'm going to be posting lots of information on my feeds via here and Instagram, but definitely let me know what questions you have. So one final note about this, because there is a lot of information about the number of people waiting on the sidelines. Economists are, debate whether it's 3 million to 8 million people who have been holding off buying a home, but that is a huge amount of demand, you guys, for the limited number of houses. And when we see demand go up and supply be down, we see prices skyrocket, and negotiations for things like closing costs, repair costs, buyers being willing to do bidding wars and pay over appraisal value, over list price. I mean, those things get way more competitive and way more aggressive in this market. So in situations where there is high demand and limited supply, you see prices skyrocket and sellers are not willing to pay the closing costs or repairs that you need. They're not willing to accept a contingency or FHA or VA financing like they should. We see buyers more willing to pay over asking price, over appraisal price. They're willing to do bidding wars and waive inspections and contingencies. I mean, it becomes madness. And for those people who are buying in Maricopa County, I talked to our local expert, Tina 𝗀𝗃𝗃𝗀, and she said that the median pay over asking price in 2021 was $20,000. Now this means that half the people paid more than $20,000 and half the people paid less. The average concession was around $3,000 for closing costs. Today it's around $10,000. That's a huge difference when you are considering like a $30,000 out-of-pocket cost in addition to your down payment, in addition to closing costs. It does not pay to wait. It does make sense if you can buy a home within your budget to buy now and consider refinancing later. Now, obviously, I'm not recommending that you buy a house that you cannot safely afford, but there is a penalty to waiting, and it could be a significant increase to your out-of-pocket expense. If you guys are curious about whether now makes sense for your budget, I have a free budget guide on my website, and my team is always happy to help you. All the links will be posted below. And if you guys have any questions or comments, don't forget to leave them below.